On January 29, 2026, silver hit an all-time high of $121 per ounce. 30 days later, it was trading below $75. Most analysts called it a correction. I called it a distraction, because while everyone was watching the price crash, 227 million ounces of physical silver were quietly walking out the back door of the world's most important exchange, and nobody in mainstream media noticed. In the next few minutes, I'm going to show you exactly where that metal went, and why what's left behind tells a far more uncomfortable story than any price chart ever could. There is a particular kind of silence that precedes a major market recalibration, not the silence of complacency, but the silence of a system under compression, where the data has been speaking clearly for months, and yet the dominant narrative insists there is nothing unusual to see. That is precisely the silence surrounding silver as of May 8, 2026, with the metal priced at $80.71 per ounce, consolidating after one of the most volatile first quarters in its modern trading history. This analysis is not about a price chart. Charts are useful for timing. They are poor instruments for understanding. What we are dealing with today is something documented in the language of the most credible annual research publication in the silver industry, the World Silver Survey 2026, released on April 15th by the Silver Institute and Metals Focus. That report did not make headlines across mainstream financial media. But for those of us who read primary sources rather than press releases, it contained a sentence on page 17 that deserves to be read slowly. The silver market has now drawn down a cumulative 762.1 million troy ounces from above ground stocks since 2021 to cover the gap between global supply and global demand. The survey described this condition with a phrase that had never appeared in its pages before. The silver market has clearly entered an era of reduced stocks. In my years tracking these cycles, I have learned that when the institutions change their vocabulary, the smart money has already changed its position. The Silver Institute does not adopt new terminology lightly. This organization has published its annual survey since 1990. When it introduces the phrase "era of reduced stocks" into its flagship publication, it is not being dramatic, it is being precise. The structural shift it is describing has been building for half a decade, and the 762.1 million ounce figure is the most concrete evidence of its depth. To put that number in context, global silver mine production runs at roughly 820 million ounces per year. The market has now drawn down from above-ground inventories an amount equivalent to nearly a full year of planetary mine output, and done so not in a single crisis moment but gradually, systematically, year after year since 2021, through 6 consecutive annual supply deficits. The 2026 deficit is projected at 46.3 million ounces, representing a 15% widening from the 40.3 million ounce gap recorded in 2025. Total supply is forecast to slip 2% while demand eases only modestly. Every year the market needs to borrow from reserves to balance. Every year those reserves are thinner. The supply side of this equation is where the story becomes forensic. We often discuss on this channel that price is merely the smoke, but the inventory data we are seeing now is the actual fire consuming the house. Nowhere is that more apparent than in the behavior of the mining industry itself. Fresnillo, the London-listed Mexican miner that is the world's largest primary silver producer, issued a production guidance revision in January 2026 that the market largely absorbed without alarm. The company cut its full year 2026 silver output forecast from a range of 45 to 51 million ounces down to 42 to 46.5 million ounces, a roughly 9% reduction, representing between 3 and 4.5 million fewer ounces reaching the market than previously planned. The stated reasons were operational: lower ore grades, mine sequencing complications, a strategic pivot toward narrower veins. In April, first quarter production came in at 11.1 million ounces, down 8.5% from the prior quarter, and the company maintained its reduced guidance rather than revising it upward. This matters for a reason that has nothing to do with Fresnillo specifically. It illustrates the structural rigidity of silver supply at a moment when the market can least afford it. Approximately 74% of global silver production comes not from dedicated silver mines, but as a byproduct of copper, zinc, and lead operations. When base metal prices decline and those operations curtail output, silver production falls regardless of the silver price. Silver supply cannot be turned on like a faucet. New mines take 7 to 15 years from discovery to full production. The supply curve is, for all practical purposes, inelastic in the medium term. That is the foundational constraint against which all demand-side pressure must be measured. My personal approach has always been to ignore the televised shouting matches and instead look at which mines are selling their future rights just to stay liquid today. The BHP Wheaton precious metals streaming transaction announced in February 2026 and formally completed on April 1st speaks precisely to that dynamic. BHP, the world's largest diversified miner, agreed to sell the rights to a portion of future silver production from its stake in the Antamina copper zinc mine in Peru to Wheaton Precious Metals, receiving an upfront payment of $4.3 billion. The largest precious metals streaming transaction ever recorded based on upfront consideration. Under the agreement, Wheaton receives silver credits equivalent to BHP's 33.75% share of Antamina's payable silver production until 100 million ounces have been delivered, after which the proportion steps down to 22.5% for the life of the mine. BHP pays Wheaton 20% of the spot silver price per ounce delivered. Read that transaction for what it actually represents. The world's largest diversified miner chose to monetize a byproduct by transferring decades of future production rights to a streaming company in exchange for immediate capital. This is not a sign of abundance. This is a signal that institutional actors are pricing in a future in which silver revenues at elevated prices are worth locking in now, and that capital flexibility has a premium that exceeds the long-term upside of holding those production rights. When the biggest players in the industry are willing to give away future production at spot minus 80% to raise cash today, the market is telling you something about their assessment of what capital will be worth versus what metal will be worth in the years ahead. The London vaulting system has been one of the least discussed but most consequential elements of the silver story in 2025 and early 2026. The London Bullion Market Association vault data, published monthly with a significant lag, showed total silver holdings in London at approximately 760 million ounces in its most recent reports. That number sounds like it represents enormous physical abundance. But the analytical work done by independent researchers, most notably the tracking of vault flows against one-month lease rates, reveals a more constrained picture. Approximately 75 to 80% of London Vault silver is held in allocated form by exchange-traded funds, principally the iShares Silver Trust, which holds its shares in London. That metal is not available to the market for settlement purposes. Strip out the ETF allocated metal, and the float, the Vault silver theoretically available for lending and settlement, sits in the range of 140 to 200 million ounces depending on the methodology. But there is a further distinction that matters even more. The difference between vault float and the actual liquid free float, the metal that is unencumbered, immediately lendable, and available to satisfy delivery obligations. Analysts tracking the correlation between SLV vault outflows and one-month London lease rates through early 2026 found a persistent inverse relationship. As SLV vault holdings stabilize near their floor levels, lease rates climb sharply, suggesting the LBMA system had become functionally dependent on ETF outflows to maintain settlement liquidity. When that source of incremental metal dried up, the lease rate spiked. The one-month silver lease rate in London reached levels in early 2026 that had historically been associated with acute physical scarcity, well above the baseline rates seen in normal market conditions. Whatever the exact number of unencumbered ounces available to the London market at any given moment, the lease rate behavior suggests it is far smaller than the headline vault total implies. Now let us examine the exchange mechanics in New York, because this is where the structural tension in the physical market is most precisely quantifiable. The COMEX silver futures system, operated by CME Group, divides warehouse inventory into two categories. Registered silver is immediately deliverable against futures contracts. Eligible silver is stored in approved vaults but is not committed to the delivery pool. It exists in the system, but its owner has not made it available for settlement. As of May 8, 2026, registered silver at COMEX stands at 79.8 million ounces. Open interest, the total paper claims outstanding against the exchange, represents approximately 496.7 million ounces. The coverage ratio, the fraction of paper claims that could be physically satisfied with registered inventory, stands at 16.1%. The stress threshold generally accepted by exchange analysts is 15%. The market is operating within 1.1 percentage points of that boundary. If there is one thing I want you to take away from our discussions, it is that a market does not break at the top, it breaks at the vault long before the public sees the first crack. The 16.1% coverage ratio is not an alarm bell in isolation. COMEX has functioned at similar ratios before. What makes it significant is the context. 6 months of accelerating physical deliveries that have drawn a cumulative 227 million ounces out of the system since November 2025, a registered inventory that has declined more than 80% from its 2021 peak, and an open interest figure that represents over 6 times the deliverable physical pool. Paper leverage at 6.2 times deliverable supply is not catastrophic by itself. It becomes meaningful when physical withdrawal demand is elevated and sustained, and when the pool of registered metal is being replenished more slowly than it is being drawn down. The India chapter of this analysis is the one most systematically overlooked by Western commentary. At the start of the 2026 fiscal year, India experienced a brief administrative freeze on bullion import authorizations, a roughly 5-week window during which the formal government notification permitting banks to import gold and silver had not yet been issued. Approximately 5 metric tons of gold and 8 metric tons of silver were reported to be held at customs without the requisite authorization. This is a recurring procedural issue at the start of each Indian fiscal year, but its timing in 2026 coincided with Akshaya Tritiya, the single most important day in the Hindu calendar for precious metals metals purchases. By the time the authorization was issued, naming 15 banks including the State Bank of India and HDFC Bank as authorized importers through March 2029, the price of silver in India had surged well above 2.5 lakh rupees per kilogram. That level represents a more than 150% year-on-year increase from the roughly 97,000 rupees per kilogram seen at Akshaya Tritiya 2025. Indian household demand for silver, already structurally elevated by the monetization of physical metal as a savings vehicle in response to sustained rupee weakness, was meeting a temporarily constrained import pipeline at precisely the worst moment in the calendar. This episode illustrates a recurring vulnerability in the global silver supply chain. Regional disruptions, even procedural ones, can produce disproportionate price shocks in markets where physical demand is structurally deep and supply channels are narrow. India is not a marginal participant in global silver demand. It is one of the largest consumers of physical silver in the world. The bear case deserves honest treatment because intellectual credibility requires engaging with the strongest counterarguments rather than building the most comfortable echo chamber. The iShares Silver Trust, SLV, experienced meaningful outflows in the weeks following silver's January 2026 peak at 121.67 per ounce. That metal, as it left the ETF and entered the LBMA Vault system as redeemable bullion, temporarily supplemented London's available supply, and lease rate data suggests this outflow was a material factor in keeping the physical market from seizing up further during February and early March. If SLV outflows were providing a cushion, then stabilization of ETF holdings, or their eventual reflation, removes that cushion from the supply side. On the industrial demand side, the World Silver Survey 2026 projects that solar photovoltaic silver consumption will decline approximately 19% in 2026 compared to 2025, driven by technological thrifting, manufacturers using less silver per solar cell, and by substitution where technically viable. The solar sector, which consumed roughly 230 million ounces of silver in 2025 and has been the largest single driver of demand growth over the past 5 years, is not growing linearly. The technology is becoming more silver efficient. That is a genuine structural headwind to the bull case, and it is one of the primary reasons the Silver Institute's 2026 deficit projection of 46.3 million ounces is narrower than many investors expected given the previous year's trajectory. The Wall Street consensus for silver through 2026 reflects this ambiguity. JP Morgan's base case average for 2026 sits at approximately $81 per ounce, a number that, with silver trading at $80.71 on May 8th, the market has essentially validated. Bank of America's metals research team, led by Michael Widmer, produced the year's most analytically provocative price scenario analysis in February 2026, applying historical gold-to-silver ratio compressions to a gold price near current levels. Widmer calculated that a return to the 2011 ratio low of 32.1 would imply silver at 135, while a compression to the 1980 extreme of 14.1, the ratio reached during the Hunt brothers' corner attempt, would mathematically produce silver at $309. Widmer framed the $309 figure explicitly as a stress scenario outcome requiring a delivery squeeze or a physical demand surge that overwhelms the paper pricing mechanism, not as a base case forecast. The base case from Bank of America's own model sits at 135. The distinction matters. I have always maintained that the most dangerous moment for a retail investor is when a structural crisis is still being dismissed as a liquidity hiccup by mainstream desks. The gap between JP Morgan's $81 average and Bank of America's $135 scenario is not a disagreement about the price chart. It is a disagreement about whether the 762.1 million ounce cumulative inventory draw represents a problem that the system can absorb indefinitely, or whether it represents a constraint that will eventually express itself in the price with force. The monetary policy backdrop adds another layer of complexity that is specific to the weeks immediately ahead. Jerome Powell's term as Federal Reserve Chair expires on May 15, 2026. Kevin Warsh, Trump's nominee and former Fed governor, cleared the Senate Banking Committee on April 29th on a 13-11 party line vote, the first fully partisan committee vote on a Fed chair nomination in the committee's history. The full Senate confirmation vote is expected during the week of May 11th. Markets are watching this transition for signals about the future trajectory of monetary policy. During his April 21st confirmation hearing, Warsh spoke of the need for a new framework on inflation without providing specific details, described the Fed's balance sheet, currently at $6.7 trillion, as having grown its imprimatur over the economy beyond what he considers appropriate, and declined to commit to the current practice of 8 FOMC meetings per year. Chicago Fed President Austin Goolsbee, speaking in May 2026, stated publicly that inflation had not continued cooling toward the 2% target and had instead accelerated since the outbreak of the conflict in the Persian Gulf region. Whatever Warsh's eventual policy trajectory, the transition itself introduces institutional uncertainty at a moment when monetary policy credibility is being stress-tested by inflation dynamics that the conflict has amplified. And then there is the policy dimension that has received almost no attention in precious metals commentary despite its direct relevance. On January 14, 2026, President Trump issued a presidential proclamation under Section 232 of the Trade Expansion Act, directing negotiations to address the national security risks posed by U.S. import dependence on processed critical minerals and their derivative products. The proclamation explicitly included silver in the scope of concern and directed the Secretary of Commerce and the U.S. Trade Representative to consider price floors as part of any negotiated agreements. The 180-day deadline for negotiators to report back on the status of those agreements falls on July 13, 2026. If agreements are not concluded by that date or are deemed insufficient, Trump retains the authority under Section 232 to impose import restrictions unilaterally. Whether or not that authority is exercised, the signal embedded in this timeline is significant. The U.S. government has now officially framed silver pricing volatility as a national security vulnerability, and the policy clock for a structural intervention is running. Against this backdrop, the gold-to-silver ratio at 58.4 carries its own analytical weight. The ratio measures how many ounces of silver are required to purchase 1 ounce of gold. At 58.4, it sits in the middle of its modern historical range, below the 80 to 100 levels seen during the 2020 pandemic period, but significantly above the 32.1 low recorded in 2011 and the 47.1 long-term historical average of the 20th century. A ratio at 58.4 is not a screaming buy signal for silver on its own. But in conjunction with a 6-year cumulative supply draw of 762 million ounces, a registered COMEX coverage ratio within 1.1 percentage points of the stress threshold, and an institutional vocabulary shift at the Silver Institute, it is a data point that belongs in the same analytical frame as the rest of this evidence. The synthesis of this analysis is not a price prediction. Anyone who offers you certainty about where silver will trade in 3 months is selling something other than analysis. What this evidence does support is a specific claim about the structural condition of the market. The above-ground inventory buffer that the silver system has relied upon since 2021 to absorb the gap between supply and demand is materially thinner than it was, and the rate at which it is being drawn down shows no sign of structural reversal. The supply response is constrained by geological and operational factors that operate on decade-long timescales. The demand response from industrial users, particularly in the energy transition and AI infrastructure build-out, is not discretionary in the way that investment demand is. And the institutional architecture of the physical market, the LBMA vault system, the COMEX delivery mechanism, the London lease rate structure, is showing stress indicators that are consistent with a market in which the easy adjustments have already been made. The primary sources for this analysis are publicly accessible. The World Silver Survey 2026, published by the Silver Institute and Metals Focus on April 15th, is available on the Silver Institute's website. CME Group publishes daily registered and eligible silver inventory data. The presidential proclamation of January 14th, 2026 is in the Federal Register. Fresnido's production guidance revisions are in their January 2026 earnings release and their Q1 2026 production report. BHP's streaming announcement and its completion on April 1st are in their investor relations filings. Read them. The argument is in the data, not in the commentary about the data. Nothing in this analysis constitutes investment advice. Silver is a volatile asset with documented historical swings of 30% or more in short periods, as January 2026 demonstrated with particular clarity. Any decision to buy, sell, or hold positions in silver, silver-related equities, or precious metals instruments should be made in consultation with a qualified financial advisor who understands your specific circumstances, time horizon, and risk tolerance. What this analysis offers is a framework for reading the structural evidence. The rest is your judgment to exercise.